Welcome, everyone. We are so glad you can join us for this on-demand webinar hosted by JFL Total Wealth Management. In the last few weeks, we've received a lot of inquiries about former Vice President Joe Biden's tax policy proposals and how this might affect your financial situation. Today, we will review these proposals, which for the main part target higher wealth individuals with more than $400,000 in annual income, and discuss what tax planning steps you might want to consider. Let's introduce today's panelist. Jerry Lynch is a certified financial planner and founder of JFL Total Wealth Management. He has been a financial advisor for 23 years, and has been working in the financial industry for more than 30.
Hello, everybody. Welcome to today's presentation. I just want to start with this. This is not a political statement. This is not a pro-Biden or pro-Trump thing. You know, there was a movie from Danny DeVito called Other People's Money, and there's this part of it where this woman comes up to him and says, someday they're going to make laws that are going to put you out of business. And his response is simple. You can change the rules of the game, but the game is going to continue. Right now, there's the ability, if the Democrats get the House, the Senate, and the White House, that they're going to change the fundamental rules of taxation in the United States. If they do, it is critical that we understand exactly how this impacts you so we can come out with some ideas to make this as good as possible for you. So again, whether it's a Democratic or Republican House and Senate and all those different things, our job is to analyze those rules and try to make them as good as possible for you and your family. So we're going to spend some time today going through a couple different things. Number one, what is Biden's tax program? How does this impact individuals? And then get into some specific ideas that we may be coming back to you towards the end of the year after this election is determined to say we may want to consider it. And I want to make sure that I'm giving you as much advance notice as possible because I understand the tax rules for 2021. I don't know what's going to happen next year. So if there's the ability for these things to change, I want to make sure that I'm taking advantage of it. So again, let's go through Biden's tax programs. Number one, there's really a couple different things that he's hitting on. First and foremost, changing some of the payroll taxes, which are really your Social Security and Medicare taxes for high net worth individuals. Changing the marginal tax rate. Again, those are the tax brackets, and also possibly changing where that income gets hit, reducing it so it gets hit at a higher level. Changing capital gains rates, which are investments that you've had in the stock market or investment that you've had for more than a year, changing them in some of those areas. Corporate tax rates. Right now, the corporate tax rate was reduced under the Trump tax program, increasing those up to 28%. And then finally, tax on things such as an annual tax on wealth, and then also greater estate and gift taxing, or bringing those numbers down. So again, there's a lot of different areas that this thing is potentially hitting, and I'm going to go through a lot of these things in a very short period of time. My advice is have a notepad, write this thing down so that if you think something is specific to you that we need to discuss, let's get on the phone and discuss it to the extent we can. Now, again, one of the first things that we were talking about is the tax on capital. So they're talking about at above incomes of above $1 million having no capital gain rate, meaning that you would pay ordinary income, which is 39.6. There's also another 3.8% Obama surcharge for healthcare, and then you have the state of New Jersey or whatever state you're in. So you could effectively be looking at a rate in excess of 50% if you're just basically liquidating a stock above that income level. They're also talking about the elimination of the step up in basis of death. Now, I'm going to get into that a little bit later in the presentation, but this is something that impacts everybody. And what this basically means is if I were to die today and I had a stock that I paid $10 for and now it's worth 100, my heirs get that. And if they sell it the next day at 100, they pay no income tax on that. That also applies to properties that we've had for a very long period of time. Many of you, or either yourselves or your parents, have had properties for 30, 40 years. Bought them at a very reasonable price, stayed in there. Now, if that were to be eliminated, it means that your kids or your heirs would have a large capital gain at the date of your death. Now, taxes provide a couple different things, and I think it's important to understand what the value of it is. First and foremost, it gives revenue to the government to basically pay for the services that we need. The second thing that it does really very well is it provides incentives and disincentives for us to do certain things. So an example of a disincentive is a sin tax. If you buy a bottle of wine, you buy a pack of cigarettes, there's an additional tax that's to disincentivize you from buying those things because it's not as healthy as people going to a gym. The incentive side is to give you things such as deductions or credits and things that they want you to do. The difference between a deduction and a credit is very easy. A deduction is a partial reduction of your tax liability. So if I pay mortgage interest and I have $1,000 deduction for mortgage interest, and I'm in a 22% tax bracket, it means I saved $220. A tax credit of $1,000 is a dollar for dollar reduction off my tax liability, so it's worth $1,000. So a tax credit is much better than a tax deduction. Now, what Biden had talked about was increasing the tax credit, which is an incentive for children, from $6,000 to $8,000. He was also discussing increasing the tax credit that you get for the Affordable Care Act, which is basically for your health insurance, expanding the earned income tax credit for childless workers over the age of 65. Again, first-time home buyers credit. So if you're trying to buy a home for the first time, giving you up to $15,000 to do that. And the retirement retirement savings credit is really if you're below a certain income, you get as much as a 50% money back on any money that you put into a 401k or an IRA. So tax credits are incredibly powerful, and part of his program is at lower income levels to give tax credits to increase the income that people have. The other thing that they're doing is, again, this is something that, again, I want to refer to as tax bracket management. Now, in 2017, these are the pre-Trump taxes. You can see the brackets starting at 10%. 15, 25, 28, 33, 35, and 39.6. 39.6 was the top bracket, and it kicked in a little bit below $500,000. Trump basically came out with the same number, but he eliminated the top tax bracket of 39.6. So the top tax bracket under the Trump program was 37%. He also reduced the 15 to 12. And in certain areas, you can see where he reduced it. So the Trump program, pretty much across the board, was substantially lower tax rates for everybody going forward. Now, so what's being proposed for 2022 potentially is that the 39.6 would kick in at a level of around 400. So right now, people at that area are either paying 35 or 37. That would bump it up pretty substantially. You're looking at a 5% increase. And even versus the old tax brackets under Obama, you're seeing a pretty substantial increase in the rates at that level. So again, this is something that's very important we're going to stay on top of. I was mentioning this before. Some of the things that we could potentially do to take advantage of this is that we can potentially do Roth conversions this year. If we think that next year the rates are going to be higher, we could take advantage of today's rates. We could harvest gains. If potentially we have large gains, we may want to take advantage of today's rates and sell those gains today at today's numbers. We may want to defer losses that we have. So normally what I want to try to do is if I have a gain and I have a loss, I want to time these things so they come in together and I create an offset. I make it as neutral as possible. Those losses may be more powerful next year than this year. So I want to take a look at that. And then most of the time for business owners, what they try to do at the end of the year is they want to write as many checks as possible, pay every expense they physically can, and put in income into next year. So their income is lower in this year. Next year, they're putting any more receivables into next year. The opposite may be true. We may want to pay those expenses in 2022 or 21 rather, and we may want to increase the amount of income we have this year if today's rates are going to be lower than what we perceive them to be next year. Interesting planning opportunities. So now one of the things with the tax system, and again, I kind of sit here in the middle, is the tax system in certain situations is unfair. And I'm just going to use an example of a $40,000 of itemized deductions. I'm not going to talk about the standard deduction right now. I'm just going to say if you have $40,000 in deductions and we take a look at different tax brackets, what's the benefit to me of having that deduction in that tax bracket? So if I start on the left-hand side and I have 40,000, and let's just say these deductions are mortgage interest, property taxes, maybe some medical expenses, maybe some charity. But if I have $40,000 of deductions and I'm a 22% tax bracket, I get $8,800 back in my pocket. And all I did was multiply the 22% times 40,000. If I'm in a 32% tax bracket, those same deductions are worth $12,800. So it's almost worth 50% more. And if I'm in the top tax bracket of 37%, those deductions are $1,480. It's almost twice the amount of money back in my pocket because I'm in a higher tax bracket. Now, under the Biden proposed system, we would be limited to deductions of 28%, meaning that if I'm on those 3 higher tax brackets, the most that I could be able to deduct on my taxes are going to be 28%, which means in those bottom 3 tax brackets, my deduction was limited. Now, one of the reasons why they like doing these things is that nobody understands your ability to have deductions. Nobody understands the alternate minimum tax. Nobody understands PEP. Nobody understands Ps. All they know is that this is supposed to be the rate that I'm paying. And the only way you really see that is if you go through a tax return and you see the impact of what this is supposed to be versus what it's going to be. So this would impact high net worth people because you think you're getting a deduction, but if you're limited, it's going to cost you more money out of pocket. It effectively raises the tax rate. Now, what they're also talking about is that for business owners, there's something called 199A that was implemented by Trump. And it allows business owners to get as much as 20% of their income tax-free, and it wasn't limited to any amount of money. So if I was making $2 million a year, in theory, 20% of that income would come to me tax-free. Now, the exceptions to that were service businesses, so for example, attorneys, doctors, financial advisors, people who were in a business where people were coming to them specific for their knowledge and education. However, if I'm a widget manufacturer, I was not subject to any of these limitations. So under the new program, I would only be eligible for this up to 400,000, and between 326 and 426, it would basically get phased out, or up to 400 be phased out. So that'll be interesting as well too for business owners. Now, what that 199A effectively did for business owners was it reduced the rate, the effective tax rate that they were paying. So in an S corporation pre-Trump, if you take a look at the different income brackets, at the highest level, I was paying about 39.6%. Okay, and really where it starts kicking in, it was really around 250, where my effective tax rate was about 33%. Under the Trump program, it reduced those rates substantially. So if I was at the highest possible tax bracket, it went from about 39.6 to about 29.6. So business owners benefited very well from this. And the thought was because C corporations tax rate went down, they wanted to make sure that people who were self-employed or had their own business weren't converting from S corporations to C corporations because the rate was reduced. Under the Biden program, again, above 400,000, it would effectively eliminate that 20%. So you're seeing that the rates would go up substantially higher. And again, for a business owner who's successful, who's paying close to 30%, you could see that rate basically increasing by 33% at certain levels. So that's a big increase and will impact a lot of people. And what it also means is we're going to have to take a look at your 401k plan. We're going to have to take a look at deferred compensation programs. You're going to have to take a look at, pension programs, things that we can do to control the income. Because if at certain levels you're losing 50 cents on a dollar, I want to be able to come up and control the amount of taxable income that you're receiving and potentially defer that into the future. Now, there's a couple other things too that we want to take a look at, and this is really dealing with the capital gains rate. One of the most substantial increases that they're going to have is that increasing the capital gain rate from as much as from 20%, which is the highest right now, up to 29.6, effectively doubling it. Now, really where this comes into play is, let's just say Warren Buffett. Warren Buffett, most of the income he receives is qualified stock dividends. So Berkshire Hathaway pays income to their shareholders every year, and he probably receives several $1 million a year in dividend income. Previously, he was taxed at 20% on that, okay, plus any state income tax. Under the new rule, he would be paying 39.6%. Where this also comes into play, and I think this could be very negative, is on businesses that want to get sold. So if somebody has had a business for 30 years, they've been employing people, paying their FICA tax, putting money in their 401k, their health benefits, and so forth, if they're potentially selling their business, they could be looking at 39.6 on any money above $1 million. So if they sell their business for $3 million, two to that $3 million is going to get taxed at 40%. There's also a 3.8% Obama surcharge, and then New Jersey also has a gain that's in excess of 10%. So effectively, you're looking at 50 cents on the dollar going away. What this means for business owners is that if you are planning on selling your business, the structure of the deal is more important than the dollars of the deal, meaning that if you're getting paid that $3 million that I just said, what I would want to do is make sure that I'm paid that income over a 3 or 4 year period of time, so I'm avoiding these thresholds. So again, from a planning standpoint, this means we really got to be on front of any of those big purchases or sales that you have going forward. So another thing that I think will be kind of interesting is, again, what it does is it encourages you not to sell a stock or something that you've had for a long period of time, because if you're going to potentially lose 50 cents on the dollar for selling something, your attitude is, well, I might as well just hold on to it, which could be good or bad depending on what you need to do. There's also the ability under the program to lose, again, what I had referred to before as a step up in basis at death. And what happens is if I have a step up in basis and I have an asset that I've had for a period of time, generally my advice to that person is hold on to it until you die. There's a step up in basis, and when you give it to your heirs, they pay no income tax. Under the new rules, one of two things may potentially happen. One of which is the tax may need to be paid based on my death. So I die, I have a gain in my portfolio. At my death, my estate may have to pay that 39.6% tax. That can be devastating because it means you need to sell the asset or you need a lot of liquidity to be able to do that. That also impacts people at a lower level. So think about this. Again, many of you, yourself or your parents, have had a home for 20, 30, 40 years, stayed in the same home. If there's no step up in basis, it's what they paid for it when they bought it is the cost that now has to go out. And if it incurs a tax at that moment, it means that you need to sell this in a very short period of time. So I don't like that. Under the U.S. traditional system, if the step up in basis is eliminated, it passes through to the person who inherits it, and the tax is only due when they sell it. So we need to stay on top of this and figure out exactly how it's going to be impacted, because it's either the Canadian system where it's due at death, or the American system where basically it goes to the next person, and then when they sell it is when they incur the tax. But it'll be interesting. We're going to stay on top of that for you. All right. Now, a couple things here, a couple very important things. The most significant proposal is a shift in taxation for wealthy individuals. So people who have higher incomes and people who have more assets are going to be impacted by this more than the Trump program. It's unclear whether or not the proposed 39.6 would apply to gains in excess of $1 million at death. Again, that's kind of big. So if for some reason I had a home and I had a portfolio and I die and that's worth $2 million, potentially you're talking about you're going to have to sell all the investments within that portfolio to be able to pay a very large tax on the real estate and on the portfolio that you have. It's unclear whether it would include a deduction for estate taxes paid. So you may potentially be looking at a 40% estate tax on top of a 39.6% income tax. And then based on states, certain states are going to have income taxes as well as inheritance taxes. So in certain situations, if the numbers work out, they could be greater than 100%. But generally the rule is if you owe more than 100%, they'll just take 100 and walk away. Either way, it means that we need to do some planning in this area. They're also, with the gifting of assets, one of the things successful individuals do is they will gift assets to kids. They'll buy stock for kids, or they had, if you worked for Exxon for 1 million years, you give Exxon stock or Microsoft stock to your kids. Now, again, under the current plan is when you gift it, they get your cost basis. Whatever you paid goes along with that. And when they sell it, that's when they incur the tax. Under possibly some of these new rules, we could be looking at a tax as soon as the money is gifted. As soon as I change ownership of that stock and I go from Jerry Lynch to Dylan Lynch to Danny Lynch or whatever the case may be, as soon as I do that, at that point I incur a tax. So we got to check on that. And you can see that between now and the end of the year, you could see a lot of people who have large stock holdings potentially selling out if this happens. And then also a lot of huge estate planning opportunities between now and the end of the year. So if you're falling into this category, my advice is right now, contact your tax and estate attorney. Start working on some ideas, because I guarantee you if this all comes through within a very short period of time, these individuals are going to be very busy. You want to make sure you get out in front of it. Now, again, the cost basis is really just what did you pay for this, minus any distributions and so forth. And any of the stock portfolios will always have that. All right. So year-end tax planning. Again, this is something we do every year. And I want to start with what's known as a standard deduction. So if I'm a single person and I earn $50,000 and I'm renting, I don't give any money to charity, I don't have anything that's deductible, technically my income is $50,000 minus $12,400. So that comes out to, what is that, $37,600. That's what I'm going to have to pay tax on. So effectively, $12,400 is tax-free. If I'm married, that deduction is $24,800. So it basically brings you down. Now you can use one of two different things. You could use a standard deduction, or you could use an itemized deduction. Where you use an itemized deduction is when your itemized deductions, your mortgage, your property taxes, your charitable contributions, medical expenses are greater than these numbers. So if that's the case, that means you would use itemized. If it's lower, you have the 24. Now the problem with that, and actually, let's go to the next slide. I think there's some interesting things there too, and I'll kind of bring it back. What I use this for is what's known as tax bracket management. So if I'm thinking about how am I getting income this year, I want to make sure, especially between the 24 and 32% bracket, that's a big increase. That's a 33% increase in the tax rates. So if potentially my income was $350,000, I'm a family, what I would want to do is everything I physically can, max out my 401k plan, possibly do contributions to charity to get it down. So I'm not in the 32% tax bracket, but I'm in a 24% tax bracket. Now, when I hit that next bracket, all of my income is not taxed at a higher level. So if for some reason I remained at the end of the year at $350,000 of income, only the income above $326,000 would be taxed at the higher rate. But generally what I want to do, especially if I'm looking at Roth conversions and so forth, is making sure I'm staying in the correct tax brackets. On the bottom, capital gain rates are now either 0, 15%, or 20%. So if I have a family and they're retired and their taxable income is $60,000, one of the things I want to do is take a look at a portfolio. Do I have $20,000 of gains somewhere? I want to sell those gains. I want to get 20 grand of income that I'm going to pay no income tax on it because the tax bracket there is 0. And then maybe 31 days later, I buy that stuff back if I really enjoy it. All right, but what I want to do is I want to make sure I'm filling up that bucket and getting as much tax-free income as possible. Next bracket is 15%. So again, this year I may want to take a look at this and see, do I want to receive income in a 15% tax bracket? And finally, the top tax bracket for a family is a little bit lower than $500,000. At that bracket, you're getting taxed at 20%. If I think next year my income is going to be substantially higher, I may want to sell assets this year. But this is something I'm always going to look at when we're talking about tax planning, because I want to know the brackets that you're in and do my best to basically stay in the lowest possible tax brackets available. Now, previously, one of the things that we wanted to do was accelerate deductions. Every year I want to do as much as I physically can. Sometimes I would tell people to pay their property taxes a little bit earlier in the old days so they could get the deduction this year. Under the new rules, basically what I want to do is I want to time those deductions. I want to make sure that there's a reason why I'm taking the deduction that makes sense. So it might make more sense for me to push back those deductions as a business owner and even as an individual into next year. For example, right now under the current program, I'm limited to $10,000 in state and local property taxes, referred to as the SALT taxes. So many of you who pay high income tax in the state of New Jersey and high property taxes in the state of New Jersey can't deduct fully this. Under the proposed program with Biden, that may be eliminated. So those deductions going into next year could be more potentially powerful in next year than it will be in this year. So again, I got to take a look at the specifics of everybody's case, and I want to make sure that there's a strategy behind where we're taking a deduction and why. Now, this is a perfect example of this. Now, let's assume, again, I had mentioned before that the standard deduction is $24,800. If you're using a standard deduction and you're giving money to charity and you're still ending up using a standard deduction, there's no tax benefit of doing it. In this situation, what the person is doing is they're not using a standard deduction because their total itemized deductions come out to $25,000. And basically what that is it's $10,000 in state and local property taxes. They have mortgage interest of $5,000, and they're doing $10,000 a year in charitable contributions. So effectively, what this means is, out of that $10,000 charitable contribution they're giving, really only $220 of that is tax deductible. Now, so if they're doing that over a 3-year period of time, they've effectively given $30,000 of money to charity, very charitably inclined, and a lot of you are. And out of that, you got basically around $220 back in your pocket. You got a tax deduction of $220 per year times 3 years. If you're in a 33% tax bracket, you're getting back $220. Not that effective. So in terms of how do we do this better? Well, what we can do is instead of doing $10,000 a year, why don't we do $30,000 this year? All I've done is compressed those $10,000 a year into 1 year. So now I am passing the threshold substantially. Instead of getting a $25,000 standard itemized deduction, I'm actually ending with $45,000. I'm getting another $20,000 of deductions in this year. Now, again, I would want to time that so that's working with some other things I'm doing as well, too. By doing that, I'm getting $7,700 back for doing it. It's almost $7,000 more than what I was doing before. Now, one of the rules I have is that when we find ways to do it like this, one of two things happen. Either you could give more money to charities that are important to you, or I want you to take that $7,000 and I want you to take your vacation and pay for it by the IRS. I want you to enjoy your family and use the savings to go out and have a good time. Either one of those strategies, I think, work perfect. Now, there's another better way to even enhance this farther, because if I'm giving money, I'm giving cash money into these charitable organizations. First of all, again, I could give them cash directly in 1 year, but what I could even do better is I could use what's known as a donor-advised fund. And what I like about this is that if I give $30,000 out to charities this year, the charities next year are going to come back and say, remember that money you give me? Can you give me some more? It's going to put me on a course where I feel obligated to give more and more money. If I use a donor-advised fund, I'm giving a $30,000 contribution this year into a fund, okay? And then I just contact the organization and say, give $10,000 or $5,000 to my church, give $5,000 to the Make-A-Wish Foundation, or whatever charities I want. I'll tell them when I want that money to come out. So I'm still giving the same amount over 3 years, and the contributions could be exactly the same as the way I was doing it before. The benefit here is I get a deduction in 1 year. And I could do it one step farther, okay? What I could do is I could use appreciated securities. So that AT&T stock that I got 27 years ago, I could donate that into the donor advised fund. I could get a full tax deduction on the full amount of that money. I avoid any capital gains that I have to pay and any income tax. New Jersey doesn't have a capital gains rate, so it's all ordinary income in the state of New Jersey. So I eliminate those taxes. On top of that, because I'm itemizing, I'm getting a much better deduction. So as I mentioned in the beginning of this, it's a matter of taking a look at what are the rules, how does the rules of the game work, and then just seeing how we can incorporate it into a strategy that works effectively for you. So this is a very good way that we could, again, time the deductions and use them a little bit more effectively. Now, again, gains and losses. So one of the things that we may want to consider this year is harvesting gains. Most of the time, I don't want to harvest gains. I want to let those gains continue to go. And the only time I'm going to use a gain is if I have a loss to offset it. But if I think next year I may be in a higher tax bracket, there is a benefit of me accelerating the income into this year. Sell assets in the current year, pay tax at potentially a lower rate, especially if I'm in a 0% federal tax bracket. And then I could repurchase those assets over a period of time if I really like them. I could go back, get the gain today, and I could go back and I could buy them over a period of time. Now, again, there's a trade-off for doing this. First of all, it effectively it recognizes capital from a future rate into today's current rates. Now, again, there's a trade-off for that, and the trade-off is effectively I got to pay the taxes today. So we need to take a look at, does it make more sense to do it today? Does it make more sense to do it tomorrow? What is the cost of using the money today? Do we have the liquidity to pay for it? So again, there's some calculations we have to do there. Now, normally what we're doing too is that we're harvesting losses. Now, every year I want to look at a portfolio. Even in a good year, there's something that's lost money, because if we're diversified and we're spread out, something lost money. So what I want to do is I want to sell those assets that lost money to offset either capital gains that we have, or I could use that to offset some ordinary income as well too. And by doing that, I could effectively wipe out any taxable gains that I have in this. I could sell a gain, I could sell a loss, and it basically makes it neutral. On the surface, it produces an economic benefit equal to the tax save, but generally it provides a timing benefit. So we got to take a look and see, does this make sense for you? So assets purchased that have a lower cost basis than are sold, and therefore more capital gains taxes owed in the future. So it's, again, we need to take a look at how are we setting this thing up, but there's some tax benefits of doing it. Now, again, from a tax bracket standpoint, some things are effective, some things are neutral, some things are ineffective. So here, what this means is if I have a short-term loss, I bought a stock today, I had it for 3 weeks, and I lost money on it, and I have a short-term gain. I could use, again, I had a stock for 4 months and it made money. I could sell that gain to offset that loss. So it's neutral. I don't benefit, but I'm not paying a tax on it, which is effective. If I have a short-term loss and a long-term gain, I cannot use a long-term gain to offset a short-term loss. Now, the other thing I'm going to say with this is you shouldn't have short-term losses. You should never buy a stock without the intention that I'm holding this thing for at least a year. If you're getting in and out and in and out, that's insane. It's the worst possible tax bracket to be in. Now, if I have a long-term loss and I have a short-term gain, that's incredibly effective, because what happens is short-term gains are taxed at your highest possible tax bracket. Capital gains or long-term losses are taxed at a much lower bracket. So it's a way that I can leverage a loss and offset a gain that's going to be at a much higher rate. And a long-term loss versus a long-term gain, again, it's neutral. So if I have a $10,000 stock gain that I've had for years and years, and I have something that lost $10,000, I could sell both of those, and then effectively it ends up being neutral. Now, I could also sell an extra $3,000 of losses, and what that does is I could use that to offset my income. If I'm in a 33% tax bracket and I write off another $3,000 of loss, that effectively puts $1,000 back in my pocket. That's something that we look for every year. Now, again, one thing you have to watch out is for something called the wash rules, which means you can't purchase the same thing within 30 days if you're selling at a loss. If you're selling at a gain, not a problem, but if you are selling at a loss, I buy Pepsi at 10, it's at 5, I sell it, I cannot buy Pepsi back for another 30 days. Got to make sure you watch that. Okay, from retirement income planning, there's a couple of things you want to make sure that you're doing too. 401ks and IRAs are excellent tax shelters. Statutory means that they're set up specifically by the government. They want you to save for your retirement. That was getting into what we were talking about here before. They give you incentives to save through the use of tax credits if you're at certain levels, or tax deductions if you're at higher levels. You can make IRA contributions up to April 15th of the previous tax year. So you have till April of next year, if you don't have access to a 401k at work, to do an IRA contribution for yourself and your spouse. Deductible contributions can also help you with staying within your tax brackets. I was talking about tax bracket management before. So again, I could make sure that I'm taking advantage of certain things. So from a Medicare standpoint, I'm paying less. From a tax rate standpoint, I'm paying less. There's a bunch of different things that we could do with the Obama surcharges and so forth. Most importantly, all things considered, if I have the same investments in an IRA or a 401k versus a taxable account, the IRA will do better. And it will do better because there is no tax drag on that. I don't have to pay income on dividends that are being paid by those stocks. I have no capital gains tax that are paying. So the IRA money and the 401k money is going to be more effective in long-term growth. So you need to take advantage of these things. Now, again, there's some limits on IRAs and 401ks. Again, to the extent you can, if you can max these things out, max it out. I never met anybody in retirement who said, listen, I got way too much money. Can you help me out and give it to somebody who really needs it? So whatever you do today, there's a benefit of doing it. The earlier you start, the better. You know, if you're in your 50s and 60s, it's fine. Do whatever you can do. But you want to max these things out. And if the rates go up next year, you want to make sure you're maintaining that level. Now, again, when I'm looking at where do I put money, one of the reasons why I always look at a tax return when I'm talking to individuals is that I will set up specific investments for you based on your tax bracket. So if you're in a lower tax bracket, I want taxable income, I want capital gains, and I want qualified dividend income, qualified dividend or stock dividends. Why do I want that? Capital gains get taxed at 0% for people who are in these tax brackets. Qualified dividends, stock dividends get taxed at 0. I want to get income taxed at 0. Secondly, if you're in a 22-24% tax bracket, I want to make sure I'm looking at IRAs, 401ks, 403b plans, 457s, things that I could defer income and basically have it growing. And if I'm in those top tax brackets, I want to make sure I'm taking advantage of Roth IRAs, life insurance, tax-exempt interest, muni bonds, things like that. I want to make sure that we're setting you up in investments that make sense based on your specific tax situation. Okay, now, Roth conversions, love them. Love the concept of a Roth, but you need to understand the math. All things being equal, there is no difference between a traditional versus a Roth IRA. And let me show you the math here. I have $1 million in an IRA, and I have a Roth. And basically, the only thing I'm going to do in the Roth is I'm going to take out $400 grand to pay for income taxes, federal, state. Boom, it's done. So now I have $600,000 in a Roth, and I have $1 million that's in that traditional IRA. I have them in exactly the same investments, and they get exactly the same rates of return, 200%, okay? And then when I die, I have $3 million in the traditional IRA, and I got $1.8 million in a Roth. If I back out 40% income tax, the numbers come out the same. So all things being equal, there is no benefit of a Roth versus a traditional IRA. So if there's no benefit, if all things remain the same, why would I ever suggest that you do this? Because all things are never the same. There's always differences that we need to take a look at. So for example, in certain situations, you may have deductions that I could take advantage of right now to pay that income tax. So you're not writing a check for $400,000. You may have charitable contributions. You might have a net operating loss, investment credits, or things like that that I could use to pay for this Roth conversion. You expect that money to grow. Normally what happens in a Roth is I will make that more aggressive in terms of the investments because I don't need to do minimum distributions on it. A lot of times this is almost the way that I'm creating a life insurance policy for your kids that comes tax-free. We expect the tax rate in the future to be higher. So I want to take advantage of today's lower rates and basically have that money where I would be pulling it out and potentially being in a higher bracket. It's tax-free. Okay, and also I have money outside the account to pay this. So again, I could change the dynamics of my portfolios and I could use certain things to offset the income tax that I have to pay by doing a successful Roth conversion. And I also want to make sure I'm looking at the tax brackets. Now again, some of the things to think about too, the converted funds are not required for living expenses. Again, I want to invest this more long-term. I don't want to do Roth conversions if I need that money within a very short period of time. They expect the spouse to outlive them and will require funds for living in the future. I also think this is a tremendous way. If I have Roth traditional money, I could balance out tax liability if they are raising the rates in the future. Especially if I potentially think I'm going to owe an estate tax. In that situation we showed before, $400,000 was used for paying the taxes on that. It means my estate is $400,000 longer. I've compressed my estate. If the estate tax is 40%, that saved me $160,000 by doing a Roth conversion while I was alive. Okay, and an IRA conversion keeps a marginal tax bracket. I want to make sure that I'm sensitive to Medicare surcharges and so forth. I want to take a look at the phase outs of certain benefits and so forth. I want to see if there's an impact on the AMT. We're actually going to have a Medicare presentation and we could discuss this. Sometimes it makes sense to bite the bullet and take a hit on this thing simply because it avoids the pain going forward. And then long term, we have lower Medicare premiums because we have less taxable income. So at the end of the year, what I want everybody to do is just have a checklist, go through this stuff. Let's take a look at tax bracket management. Is there something we could do to itemize deductions more effectively? Charitable contributions. Does it make sense for me to pay more mortgage interest this year? Retirement planning. Did I max out my plan? Education planning. Can I fund 529s for my kids or my grandkids? Do I want to accelerate the gains? Do I want to push back losses? There's a bunch of different things I may want to consider. Charitable contribution timing. Now, again, from an estate planning standpoint, we may be looking at this thing, if you're very successful, accelerating some of the gifts that you want to do between now and the end of the year. Is there something happening next year that I need to know about? Something big, you're trying to sell your business, whatever the case may be. We need to get involved and be proactive on this. And if there are any major life events, I want to make sure we're changing it. Now, again, this, I don't know if this is happening next year or not. All I know is that there's a reasonable shot there may be a change in Washington. If there's a change in Washington, what I want to do in advance is give you what those ideas are and potentially how it impacts you, so that in November, and I have a feeling that November 4th, we're not going to know who the president is, and probably some of the elections as well because of the mail-in ballot system. I think some of the stuff may get pushed back a little bit. But if I'm coming back to you in the beginning of December, I want to make sure that you've had advance time to know, here's some of the things that we're looking at, this is how it's going to impact me, and potentially come back with a couple of ideas that we may want to implement between now and the end of the year. Again, as I mentioned in the beginning, the bottom line is these things are going to continue to change. One of the ways that I think we provide value to you and your family is by being ahead of the curve on this stuff. And if we see things that have a negative impact, how do we make this as good as possible for you? Are there planning opportunities that we need to be taking advantage of? So hopefully you did get our tax newsletter. Should have came out recently. Go through that, make sure you take a look at it. And if you want your family members, you have a son, daughter, cousin, Want to get a copy of that? Let us know. We're happy to put them on the mailing list. And if you have any questions between now and the end of the year, please feel free to reach out. We are planning, once this goes live and we know who the new next president is, to have something else that we're coming out with. This is what's being proposed. It's not definite yet, but if they do get the House, the Senate, and the White House, it's very reasonable we'll see some changes. And I think that's it for now. But again, I want to thank everybody for your time. Hopefully you found this helpful. If you have any questions, please reach out and give us a call, and we'll do whatever we can to make your life a little bit better. Thank you very much.
Thanks, Jerry. And as Jerry mentioned, please contact us if you have any questions. And as he also mentioned, we will follow up with some communication following the election results in early November. So stay safe, everyone, and enjoy the rest of the day.